I beat the market for 13 straight years at Fidelity Magellan. Turned $18 million into $14 billion. Averaged 29% annual returns when most professionals couldn't crack 10%. And you want to know the real secret? It wasn't genius stock picks. It wasn't insider information. It wasn't some magical system. It was 7 rules I followed religiously that nobody talks about because they're not sexy. They're not exciting. They won't get clicks on YouTube. But they work. And I guarantee you're breaking at least 4 of them right now, which is why you're not rich yet. These are the rules that separate the top 1% of investors from everyone else. The rules Wall Street doesn't want you to know, because if you followed them, you wouldn't need Wall Street. I'm Peter Lynch, and I'm about to give you the unfiltered truth that cost me decades and millions in mistakes to learn. Pay attention, because each rule you ignore will cost you years of your financial life. Rule number 1. Learn from other people's disasters, not your own. Here's what nobody tells you. The fastest way to build wealth is not by learning from your successes. It's by studying other people's catastrophic failures so you never repeat them. I didn't become one of the greatest investors by being smarter than everyone else. I became successful by reading about every major investing disaster in history and making damn sure I didn't make the same mistakes. While everyone else was reading success stories and how I made my first million books, I was reading about the South Sea Bubble of 1720, Tulip Mania, the Railway Mania of the 1840s, the 1929 crash, the Nifty 50 bubble, the dot-com disaster, the housing crisis. Every single one followed the same pattern. Euphoria, this time is different, then catastrophic losses for people who thought they were geniuses. You know what I learned? The same stupid mistakes repeat every generation with different names. In 1720, people mortgaged their homes to buy shares in a company that claimed it would trade with the South Seas. The company had no revenue, no plan, but the stock went up, so everyone bought it. Sound familiar? That's literally what happened with dot-coms in 2000 and crypto in 2021. Same stupidity, different century. I studied the Great Depression before I was even born. Read everything I could about margin calls, leverage, forced liquidations. Know what I learned? Never use borrowed money to invest. Ever. If you can't afford to own it outright, you can't afford to own it. This one rule saved me from being wiped out multiple times when other smart investors lost everything because they were leveraged. I read every biography of great investors. Carnegie, Rockefeller, even Benjamin Franklin, who lost money in ridiculous schemes. Not to be inspired. To catalog their mistakes, because they already documented their failures. I just had to pay attention and not repeat them. But what do you do instead? You lose money on the latest hype stock. Act surprised like you're the first person to fall for a pump and dump. You buy at the top, it crashes, and you're shocked. But this exact scenario played out in 1987, 1999, 2000, 2008. The information was there. Thousands of books, documentaries, case studies. You just didn't read them because you were too busy watching TikTok videos about the next 10x stock. Here's your assignment. Read 1 investing disaster case study per month, just 1. Read about long-term capital management, a hedge fund run by Nobel Prize winners who built a model saying their strategy would only lose money once every 1,000 years. They went bankrupt in 4 years. Read about Enron. Not just that they committed fraud, but how. What accounting tricks did they use? Why did smart auditors miss it? Read about Bill Ackman losing $4 billion on Valeant Pharmaceuticals. What did he miss? Each disaster you study is a mistake you'll never make. Boring? Yes. But losing your money is more boring. Trust me. Rule number 2. If you can't explain it to a 10-year-old, you don't understand it. I had a simple rule at Fidelity. If I couldn't explain an investment to a 10-year-old in 2 minutes, I didn't buy it. Period. Sounds obvious, right? Then explain to me why you bought whatever complicated thing you're holding right now that you can't actually explain. Can you explain how blockchain works? Can you explain what your company actually does to make money? Can you explain why anyone would buy their product 5 years from now? If the answer is no, then you weren't investing. You were gambling and hoping someone would buy it from you at a higher price. Here's what kills me. You'll spend an hour researching a $50 toaster on Amazon, reading reviews, comparing features, but you'll throw $10,000 into a stock because someone on Reddit posted rocket emojis. Makes perfect sense. I passed on thousands of investments during my career. Huge winners, companies that went up 50x, 100x, and I slept fine. Why? Because I didn't understand them. I'd rather miss a winner than lose money on something I don't comprehend. That's the trade-off. I passed on a lot of tech stocks in the 90s. Didn't understand them. Everyone said I was an idiot. You don't understand the internet, old man. Maybe, but I also didn't lose money when they all crashed to zero. I passed on Amazon early on. Didn't make sense to me at the time. Jeff Bezos was losing money every quarter and people called him a genius. Did I miss out? Sure, Amazon went up 100,000%. But did I lose money? No. And that's the point. When you only invest in things you understand, you avoid 90% of disasters. You'll miss some winners, but you'll never lose everything on fraud or bubbles you didn't see coming. Here's the test. Can you explain your investment to a 10-year-old? I own part of a company that sells soda. People like soda. They buy it every day. Company makes money. Give some to me. That's Coca-Cola. Simple. Been around since 1886. Still selling sugar water. Still profitable. Now try explaining. I own a synthetic collateralized debt obligation that leverages proof-of-stake consensus mechanisms to yield farm governance tokens in a decentralized autonomous organization. What does that even mean? If you need 15 minutes and a whiteboard, you don't understand it. You're just repeating words you heard on YouTube. Go through every investment you own right now. Ask yourself, how does this make money? Not why will the price go up? That's speculation. How does the business generate cash? If you can't give a simple, clear answer, sell it today, right now, before you learn an expensive lesson. Rule number 3. The big money is in the sitting, not the trading. Everyone wants to get rich by Thursday. Not happening. Never happening. I built my wealth over decades at Fidelity, not months, not years, decades. And people constantly asked me, what's the secret to getting rich quick? There isn't one. That's the whole secret. The real money isn't in the buying, it's not in the selling, it's not in timing the market or finding the next Amazon. It's in the sitting, the waiting, the doing absolutely nothing. But you can't sit still, can you? It kills you. You see someone make 200% on a meme stock in 3 weeks, and you panic. I'm missing out. Everyone's getting rich but me. So you start trading, day trading, options, crypto, chasing every hot tip, and 5 years later, you've gone nowhere. Actually worse than nowhere because you paid fees and taxes on every stupid trade. Meanwhile, the boring guy who bought an index fund 5 years ago and forgot about it, he's up 60, 70, 80%. He doubled his money while sleeping well, not checking his phone every 5 minutes, not having panic attacks when the market drops 2%. Here's the math you don't want to hear. 15% annual returns don't sound exciting. They sound boring and slow. But 15% for 40 years turns $10,000 into $2.6 million. That's not magic. That's compound interest. That's what Einstein called the 8th wonder of the world. But you don't want to wait 40 years. You want to be a millionaire by 30. So you take big risks, stupid risks. You use leverage, you trade options, you go all in on speculative garbage, and you lose it all. Or you make money, get cocky, then lose it on the next trade. You don't need home runs, you need to avoid strikeouts. Hit singles, get on base, don't swing at bad pitches. That's the whole game. But your ego won't let you play it that way because you want to brag at parties about your 500% returns. Here's your reality check. If you've been investing for 5 years and you're not beating a simple S&P 500 index fund, you're not an investor. You're a gambler with a losing record. The S&P averages about 10% per year just sitting there. If you're doing worse after all your research and trading and stress, you'd literally be better off doing nothing. Rule number 4. Over-diversification is just expensive ignorance. Wall Street loves telling you to diversify. Don't put all your eggs in one basket, so you buy 50 stocks, international funds, bonds, REITs, commodities, crypto, gold. You own everything. Congratulations. You've achieved perfect diversification and perfect mediocrity. Here's what I actually said about diversification. It's protection against ignorance. It makes very little sense for those who know what they're doing. Diversification is for people who don't know what they're doing. If you actually understand investing, you don't need 50 positions. You need 6, maybe 10. I've always believed if you can identify 6 wonderful businesses, that's all the diversification you need. 6 truly great companies you understand that have durable advantages, run by honest people. Buy them, hold them, get rich slowly. But here's the problem nobody tells you. When you own 50 stocks, you basically own the market. That means market returns, about 10% per year. Fine. But you also can't possibly understand 50 businesses. You don't have time to read 50 annual reports, follow 50 management teams, understand 50 industries. So you're not really investing. You're building a do-it-yourself index fund with more work, higher fees, more taxes, and worse returns. You'd literally be better off just buying an actual index fund and saving yourself the headache. Here's the smarter approach. Own 8 to 12 businesses you actually understand. Not 50 names from a stock screener. Not everything because you're scared. A concentrated portfolio of businesses you've researched, companies you understand, industries you follow. And if you don't deeply understand individual businesses, if you don't want to read annual reports and study competitive dynamics, just own an index fund. That's not failure, that's self-awareness. Most people would be way better off in an index fund than pretending they're stock pickers. If you own more than 20 individual stocks right now, you're over-diversified. Cut it down. Keep only the ones you truly understand. If you can't explain in one sentence why you own it, sell it today. Rule number 5, fees and taxes are silent wealth killers. Nobody wants to talk about expense ratios and tax efficiency because it's boring, but it's costing you hundreds of thousands of dollars over your lifetime. Let me show you some math that'll make you angry. You invest $10,000 per year for 30 years. Scenario 1. Low-cost index fund, 0.04% expense ratio, buy and hold. At 10% returns, you end up with $1.8 million. Scenario 2. Actively managed fund, 1% annual fee. Same 10% returns before fees, but after fees, you get 9%. You end up with $1.5 million. The difference? $300,000 gone. Vanished into your fund manager's pocket for the privilege of underperforming. That's just the annual fee. Now add trading costs. Add capital gains taxes every time you sell. Short-term capital gains can be taxed at 37%. Long-term gains are 15 to 20%. Most active traders give away 30 to 40% of their gains to fees and taxes, then wonder why they're not building wealth. Warren and I obsessed over this for decades. We held stocks for 30, 40, 50 years to avoid paying capital gains taxes. Why sell? You pay 20% in taxes immediately. Now you need to find another investment 20% better just to break even. That's stupid. Berkshire Hathaway doesn't even pay dividends. You know why? Because dividends are taxed immediately. The government takes their cut before you can reinvest. We'd rather keep cash inside the company, reinvest it, and let it compound tax-free for decades. But what do? You trade constantly. You sell winners too early. You hold losers too long. Every trade equals fees. Every short-term sale equals higher taxes. You're bleeding money and don't even realize it. Here's your assignment. Calculate how much you paid in fees and taxes last year. Actually do this. Look at your 1099. Add up capital gains taxes. Add trading commissions. Add expense ratios. If that number is more than 0.5% of your portfolio value, you're trading too much and paying too much. Switch to low-cost index funds. Stop trading. Hold for the long term. This might be worth an extra $500,000 over your lifetime. Rule number 6. Your emotions are designed to destroy your wealth. Your biggest enemy isn't the stock market. It's not the economy. It's not inflation or interest rates. It's you. Your emotions, your fear, your greed, your panic, your FOMO. When the market crashes, you panic and sell. When it's booming, you FOMO and buy at the top. You do the exact opposite of what you should do. Everyone knows you should buy low and sell high. Nobody does it. You know what people actually do? Buy high when everything feels safe, sell low when everything feels scary. Let me give you real examples. March 2020 COVID hits. Market crashes 34% in 1 month. Fastest crash in history. What did most people do? Sold everything. This is the end, the next Great Depression. What did smart investors do? Nothing. Actually, we bought more. Market was on sale. What happened? Market fully recovered by August, hit all-time highs by year-end. Everyone who panicked and sold locked in their losses permanently. Then they were too scared to buy back in. They missed the entire recovery. Then 2021 comes. Markets booming, crypto going insane, meme stocks exploding, everyone's making money, or so it seems. What did most people do? Jumped in with both feet. I'm missing out. This time is different. What did smart investors do? Waited, sat on cash, didn't chase. What happened in 2022? Market crashed. Crypto crashed 70%. Meme stocks gave back everything. All those diamond hands turned to paper. All those people who bought at the top are still underwater. Here's the pattern. When you feel like you should sell, when your gut is screaming to get out, that's usually when you should hold or buy. When you feel like you need to buy, when everyone's making money and you're missing out, that's usually when you should wait. Your emotions are designed for short-term survival. Run from the lion. Fight the enemy. Great for staying alive in the jungle. Terrible for building long-term wealth. Write down your investment rules right now, not during the next crash. Now, when you're calm, I will not sell during crashes unless I need living expenses. I will not chase hot stocks. I will not check my portfolio more than once a month. Whatever your rules are, write them down. And when the next crash comes, read your rules and follow them, not your feelings. Rule number 7. Most people quit right before it works. This is the killer. This destroys more wealth than all other mistakes combined. Most people try investing for 3, maybe 5 years. They don't get rich. They get frustrated, bored, they quit. Investing doesn't work. The game is rigged. Only the rich get richer. Here's what they don't understand. Wealth compounds slowly at first. Painfully slowly. For the first 10 years it feels like nothing's happening. You put in money every month. Numbers go up a little, down, up a little more. It's boring. After 5 years you think that's it, this is all I have? But here's what happens if you keep going. Years 15, 20, 25, 30, suddenly the numbers start moving fast. Really fast. Because you're not just earning returns on contributions anymore. You're earning returns on returns. Returns on returns of returns. That's compound interest. It's exponential, not linear. The first $100,000 takes forever. Feels impossible. But the second $100,000 happens way faster. The third, even faster. By the time you hit $500,000 or $600,000, they're coming every year or two. But you only get there if you don't quit. I didn't make serious money until my 40s and 50s. That's 20 to 30 years of doing the same boring things. Buying good businesses, holding them, reinvesting dividends, not selling during crashes, not chasing bubbles, just being patient and disciplined for decades. Most people don't have that patience. They want results now. When they don't get them, they quit. They try stocks, doesn't work, switch to real estate. That doesn't work fast enough. Try crypto. That blows up. Try options. Spend their entire lives jumping from strategy to strategy, never sticking with anything long enough for it to work. Here's the truth. The stock market has returned about 10% per year for the last 100 years. Through world wars, depressions, recessions, crashes, bubbles, 10% per year on average. That means if you invest consistently and don't do anything stupid for 30 years, you will build significant wealth. Not maybe. You will. It's math. It's inevitable. But you'll be tempted to quit in year 3 when there's a crash and you're down 30%. In year 7 when your friend made 500% on crypto and you're only up 80%. In year 12 when it feels like you're going nowhere. That's when most people quit. Right before the exponential growth phase kicks in. Don't be that person. Pick a strategy. Index funds, dividend stocks, value investing, whatever. Something boring and proven. Then stick with it for 30 years minimum. Not 3 years. 30. Don't quit when it's hard. Don't quit when it's boring. Don't quit when your friends are making more doing something else. Just keep going. Keep contributing. Keep reinvesting. Through crashes, through booms, through boredom, through FOMO. That's it. That's the whole game. These 7 rules aren't sexy. They won't make you rich overnight. They won't give you stories to brag about at parties. But they work. They worked for me for 13 years at Fidelity. They've worked for every successful long-term investor I know. You won't get rich in 5 years. Probably not in 10. But in 30 years, you'll be wealthier than 95% of people. And you'll have done it without stress, without gambling, without getting lucky. Just by being patient and not being stupid.